2 days ago, the US experienced the second biggest bank failure in its history. In this episode, we'll talk about what that means for the Australian economy. We'll talk about what that means for Australian interest rates. Are we now on track to have interest rates paused? And in turn, what does that mean for the Australian property market? I'm going to share with you like 5 or 6 really interesting charts. Like, this is a technical episode, and the last chart is going to like blow your mind. That's not just clickbait for you, so you stick around to the end. Like, when I saw that chart, I was like, damn, that's a little bit scary. All right, so if you're interested, carry on watching. So let's get you up to speed real quick. So if you're not across the SVB or Silicon Valley Bank saga, here's a short version of what's going down. I'm just reading from here. So they basically borrowed short and lent long. That's what banks do. That's how they make money. And many of their clients are like tech firms, right, in Silicon Valley. The problem is that they borrowed so much short that they needed to lend long. They needed to make money. So how did they do that? They invested it in long duration bonds, US Treasuries and agency mortgage backed securities, MBS. You know, if you were around in the GFC, I did my thesis on it at university. That's kind of a scary thing. These are safe investments if held to maturity, but if you can't hold it to maturity, that's crazy. Like, that is hugely risky. That's what created the GFC. Okay, so what happened is that this time the bank didn't actually hedge its interest rate risk. Okay, so what happens is these mortgage-backed securities, these bonds, they drop in value every time interest rates go up, and interest rates went up too fast, and therefore the book value, the mark-to-market value, the book value of their securities, of their assets, plunged, making them insolvent. They put this in a footnote in one of their presentations, and analysts, investment banks picked up on it, and there's huge run on the bank. In other words, people are like going to the bank, trying to get their money out. That's not a good thing. The second biggest bank failure in US history. Now, of course, the US government came in and said, don't worry, we're going to take care of all the deposits. No one's actually going to get hurt. But this creates a massive problem for sentiment. Property markets, interest rate markets, money markets, economies are swayed oftentimes more by sentiment than real data. The AFR has reported that the Silicon Valley Bank meltdown may mean that the run of interest rate rises may be over. Bond traders and big economists are predicting, because of fears of the Silicon Valley Bank collapse could cause a recession, that interest rates may no longer rise. In fact, Nomura, which is actually a very respectable investment bank, went as far as to forecast that the US Federal Reserve will cut rates next week. Now, I don't think that's actually going to happen, but the fact that a really reputable, this isn't like some third-tier bank, this is like a Big 12 bulge bracket investment bank saying that they expect rates to cut, that shows the order of magnitude of how big of a deal this is. Maybe it's not the same as Bear Stearns, Lehman Brothers collapsing back in 2007, 2008, but it's pretty close, and we shouldn't underestimate how jittery financial markets will be now because of this. The full impact of the biggest bank collapse since the 2008 GFC has a long way to play out, the AFR reports. The shock could be enough to slow down interest rate rises. Actually, what they're saying is that the likelihood the Reserve Bank will pause in April jumped to 72% from 52%. That's what consensus traders are saying. And the peak cash rate is now likely to fall to 3.9% from 4.1%. So not only is Nomura saying that the Fed in the US, their central bank, will cut rates, they're saying that the Australian RBA rates are probably not going to rise anymore. It's saying that they'll be paused. 72% chance. This is what the biggest investment banks are once again saying, and that our peak rate, or where the peak interest rate will lead to or land, will be down. Now, let's have a look at why this is so important in the Australian context. Let's look at our mortgage-backed securities. Now, mortgage-backed securities are simply like home loans that are traded in the secondary and tertiary markets by the bank who initially lent them to you and I with other banks. This, how money goes into this vortex of the money market, and it's traded based on its likelihood of being paid back. And you can see the latest figures, this kind of blue chart, the light blue and green, that dictates or denotes different days, 30 to 60 days, 60 to 90 days, 90-day plus in terms of delinquency rates, okay? So prime RMBS, mortgage-backed security delinquency rate, actually increasing now. That's actually increasing. So what's going on is that it's been decreasing, even through the start of the interest rate cycle, which happened around here, March to May 2022. That's kind of where interest rates really started to go up. And then, as you can see, really by the end of last year, these delinquency rates are going up. So the Australian Financial Regulatory System, APRA, as well as the RBA, is not blind to these statistics. And they know that this could continue going up if the contagion from what's happening in the US severely impacts the money markets here, severely impacts the stock market, severely impacts credit conditions, bank-to-bank lending, and then therefore consumers will be sucked dry. What's even more interesting is that those RMBS, or those home loans that were issued since sort of the second half of 2022, those are the ones with the highest delinquency rates, which makes sense because that were people buying at the top of the markets in Sydney and Melbourne, let's say, right? And so those people have highly LVR'd position, high leverage in their portfolio. You can see that 2022, which is denoted by this maroon line, it's kind of hard to see, that is shooting up. Like this is the stats, like this is the facts. I can't make this up. That's shooting up. Okay, so once again, that plays on the RBA's mind to say, look, do we really want this to continue to go up? Do we really want to cause more and more pain? They do want to cause pain. That is their whole purpose. That is how you bring inflation under control if it is demand-led. All right, that is how you create pain in the household budget so people spend less, and so therefore the cost of goods and services due to lower demand comes down. This is exactly what they want to see, but they want to be careful not to overdo it, because if this goes up, and up, then that causes severe issues and a real hard landing for the economy. One thing I do want to note here is that this green line, which is 2015 loans, they are actually much higher than where we're trending right now with this maroon line. So delinquency rates were much higher for much longer. So it's not like we all of a sudden will expect a housing crash. In fact, there was no housing crash in 2015 or 16. It sort of started in 2017, but that was a 7% retracement, not very big. But we certainly don't want this maroon line to be more exaggerated than this green line. And the RBA will see this, and they will couple this with what's happening in global money markets and that negative, that fear, that contagion that can occur in order to potentially pause rates. Now you can see here in this chart, Australian household interest and dividend outlays are really going up. They're really going up, which is of course unsurprising with interest rates going up, and they're almost beyond, well, they are beyond the levels back in 2011, which is when we had high interest rates and interest rates started coming down. Okay, so we're at unprecedented levels just in the last sort of, you could say, 12-13 years. In that context, once again, the interest rate rises are having their effect. How much more does the RBA want to cause pain? They need to be very careful. And once again, this further exaggerates that thesis that interest rates might be on pause. I'm just saying might, maybe not next time, but certainly the month after. But like I said before, money markets are expecting a 72% chance that interest rates won't go up in April. Another argument for putting rates on pause is the unemployment numbers. This is the Westpac consumer confidence and the unemployment rate. What we're seeing is that the yellow, which is the Westpac consumer confidence, the leading consumer confidence metric in Australia, is basically tanked. Like it's almost worse than the global financial crisis back here in 2008, 2009. And what we're seeing then is that the unemployment rate is likely to follow. Unemployment is likely to increase, in other words. So it's not like, all of a sudden, jobs are out of control. There's too many jobs, too much demand. All of that is actually likely to be pulled back, which is counterintuitively a good thing. We do want unemployment to go up. We want it to go up beyond 4%, touching hopefully 5%, because that means the economy is cooling down. That's in the works, because you can see there's a clear correlation correlation between consumer confidence and unemployment, and consumer confidence is coming down, and so therefore the unemployment rate should be going up. Hyperinflation. Hyperinflation is something everyone talks about. It's like, no. We need to be very careful about pausing rates too soon, too early, because what if wages spiral? Hyperinflation means that everything's super expensive, right? Inflation, and then wages start to become really expensive. Then people can spend even more. So then goods and services become more expensive. Then wages go up, and it's like this spiral effect where it's hyper. It goes beyond control. But you can see that's not really the case in Australia. Wage growth year on year, this grey line, yes, it has been going up after a decade of basic stagnation in real terms. Yes, annual underlying inflation is going up, but you can see wage growth isn't really following. It's not really going up at the same order of magnitude. So I think that argument for hyperinflation is overcooked. Okay, it's a bit of a hyperbole, and I don't think that's a problem. Once again, another point or another arrow in the arsenal to say, look, do we really need more rate rises? I thought this chart was really interesting from the IMF. What this is saying, okay, is that they constantly revise their forecast. The International Monetary Fund, they forecast or predict the global financial output or GDP growth for basically every big country around the world. And this chart that they released just in February, okay, so what you've got here is if it's positive on the vertical axis, that means that they predict GDP to grow 1%, 2%, 3%, 4%. If it's negative, the IMF expects GDP to go down. In other words, negative 1%. And this horizontal axis means that versus their last prediction, how have things changed? So if you're on the right hand side, they're saying that we underdid it. We think that economy will grow more than what we thought last time. If it's on the left hand side, they're saying that the economy will grow less than what we thought last time. And you can see here Australia, AU, it's been revised downwards. It's gone from right to left. It's on the left hand quadrant, which means that they've revised it down. And it is still positive. So they're not expecting a recession in Australia. So they're still expecting a soft landing, despite the IMF being very, very pessimistic on Australian house prices. Yet they have revised it down. So they are saying that, look, guys, you are potentially having that interest rate rise have a real effect, real impact on GDP growth. It's not going to mean you go into a recession, but you have to be very careful because your GDP growth is being truncated, month on month in terms of our predictions. So that's, once again, another thing. Of course, the RBA has its own forecasting models, but they need to be very careful not to raise too many more rates too quickly by too much. I think that's another arrow in the arsenal to say a rate pause is due. And the last chart, and I promise you that the last chart will blow your mind. Check this out, right? Stay with me, guys. This is from the US Treasury. This is as formal as you can get. Historical and current policy projections for debt held by public. Debt held by the public from 1980 to 2096. So it's looking forward almost 100 years. Now, this is really scary. Check this out. What they're saying is that 2021, this is released 1 or 2 years ago, historical growth in debt held by the public. This is obviously basically home loans, private debt, like credit cards and things as well, personal loans, but mostly just home loans, right? They're saying that, yes, it's increased. It kind of went down a little bit here in the GFC area, and then it's gone up. But check out their forecast. What they're basically saying is that modern monetary theory, the modern economy, the world as we know it in its capitalistic, free market stance or structure relies on debt. Okay, so they're saying that, yes, let's get over, they probably didn't predict it, let's get over this inflation hurdle. It's going to pass probably by the end of this year. But we're going to debt you up again. And that is the bedrock in which this consumer society, both in the US, Australia, most parts of the world, works. This is the green light. This is phenomenal. This is on an index basis. They basically think that we'll have a linearly steep gradient in terms of debt held in consumer household balance sheets. That is so crazy. That means that they're basically saying that we're not going to get wealthier and wealthier, but rather our standard of living will only improve by taking on more and more debt. What that in turn means is that the fiat currency, the value of currency will further debase, it will further go down, and that only real assets, hard assets, will have any value, things like housing. So when I look at something like this and say that, household debt will only get bigger and bigger, that means that I need to take my cash out of the bank, which is going to erode more and more with inflation, right? Debt means inflation in the long term, and I need to put that into hard assets like real estate. So the overall snapshot or the upshot of this whole episode is that a rate pause is probably likely to come sooner rather than later. The market thinks the RBA won't rise rates next month in April. The market thinks, or at least Nomura thinks, that the Fed will actually cut rates next month. The banking system is jittery now, mostly caused by sentiment, by this second largest bank failure in US history. I think we're in for rates to start going down by the end of this year. That's my personal prediction. I've been wrong before, but I'm just telling you how I can see it in a moment in time based on the data. And lastly, long-term house prices, they can only go up if the Federal Reserve knows what it's talking about, which is arguable, but they do control basically the world's economy. Guys, if you got some value out of this, I know it was a more technical video, then leave a like. What do you think though? Like, I could be completely wrong, right? But I'm just telling you how I see it. What do you think? Do you think the RBA will continue to raise rates? Leave a yes below in the comments. If you think a pause is coming based on this big news, leave that in the comments. Leave a pause in the comments. Guys, I just want to try to bring you as much value as possible to really level up. Go check out my podcast and Facebook group with now more than 30,000 members. Amazing Australian Property Mastery with PK. I'll leave the links to both the podcast on Spotify, iTunes, and Google Podcasts below, as well as the Facebook group. This was really interesting. If you want more videos, let me know. I really enjoy making videos like that. I'll see you next time. Bye.